Welcome to Problem 14.3b, Bond Premium, Entry for Bonds Payable Transactions. Rogers Corporation produces and sells football equipment. On July 1, 2016, Rogers Corporation issued $65 million of 10-year 12% bonds at a market-effective interest rate of 10%, receiving cash of $73,100,469. Interest on the bonds is payable semi-annually on December 31st and June 30th. The fiscal year of the company is the calendar year. Instructions. 1. Journalize the entry to record the amount of cash proceeds from the issuance of the bond on July 1, 2016. If we are recording the issuance, it means that we are selling the bonds, which means we are receiving cash. As I've said in problems before, normally you skip a line so that you can determine whether you should be debiting or crediting the premium or discount, depending on which it would be. But we do need to credit bonds payable. And no matter what, whether it is a premium or a discount, we will always credit bonds payable for whatever the face amount of the bond was. And in this case, it was $65 million. The amount of cash that we received from the issuance of this bond is $73,100,469. This would tell us that we received more cash than what the face value of the bond is, which means it is a premium. It also shows us that based on our debits and credits is that we would be crediting premium on bonds payable. And this amount would be the difference between the $73,100,469 and the $65 million bond face amount, giving us a premium of $8,100,469. Instructions number 2. Journalize the entries to record the following. A. The first semi-annual interest payment on December 31st, 2016, and the amortization of the bond premium using the straight line method, round to the nearest dollar. B. The interest payment on June 30th, 2017, and the amortization of the bond premium using the straight line method, round to the nearest dollar. To record the interest payment, we are recording an interest expense. So we would debit interest expense. Because the premium on the bond payable was originally set up as a credit entry to amortize it out, otherwise move to a balance of 0, we would have to debit premium on bonds payable. And the final journal part would be a credit to cash as we make the interest payment. To determine the amount of the cash payment, we should take the face value of the bond, which is $65 million, times the contract rate of the bond, which is 12%, and then divide that by 2, because it is a semi-annual payment. This would give us a cash payment of $3,900,000. To determine what the amount should be amortized out of the premium on this particular bond each time we make an interest payment, remember that it says straight line, so we would take the actual premium on bonds payable, the $8,100,469, and we would divide it by the number of interest payments that there will be in this length of this bond. It is a 10-year bond, 2 interest payments per year, which means 20 payments. So the $8,100,469 divided by 20 and then rounding to the nearest dollar would be $405,023. To determine the amount of the interest expense, we would find the difference between the cash payment of $3.9 million and the $405,023 we are amortizing out of the premium on the bonds payable, giving us an interest expense that we would record at $3,494,977. The requirement also asked in Part 2 that B would be we record the June 30th, 2017 interest payment. Because this is a straight line amortization of the premium, the journal entry should look exactly the same as the December 31st, 2016 entry, which would be a debit to interest expense for $3,494,977, a debit to premium on bonds payable for $405,023, and a credit to cash for $3,900,000. Part 3 says determine the total interest expense for 2016. The total interest expense in 2016 would only be the amount that was recorded here because we only had one interest payment in 2016. So the interest amount would be $3,494,977. Please note that if it had asked for 2017, it would be double this amount because we would have had the June 30th and the December 31st payment in 2017. We are skipping Part 4 of this problem and going on to Part 5. Part 5 says compute the price, otherwise the $73,100,469 received for the bonds by using the present value tables in Appendix A at the end of the text. Round to the nearest dollar. We would start with the face amount of the bond, which was $65 million. Since we also already know what the semi-annual cash payments are, we can put that here, which is the $3,900,000. And then we would go to Appendix A in our textbook, and we would find the present value of one factor for the face amount. Remember that it is 1/2 of the market or effective rate that we would be using to determine this. Since the interest rate for the market is 10%, we would divide that by 2, giving us 5%. We would go to the 5% column, go down 20 periods, and the present value factor would be 0.37689. To find the present value of the face, we would multiply the face amount, $65 million, times the present value factor. And remember to round to the nearest dollar. So the present value would be $24,497,850 for the face amount. But remember, we also have to find the present value of the cash payments before we are finished. In this instance, because this is a series of payments that are the same, this is an annuity, so we would go to the present value of an annuity table. We would go to the 5% column, go down 20 periods, and we would arrive at a present value factor of 12.46221. To find the present value of the cash payments, we would multiply the $3.9 million times the 12.46221. Rounding to the nearest dollar would give us a total of $48,602,619. So to find the issue or present value of this bond, we would add the present value of the face to the present value of the cash payments, which gives us a total of $73,100,469, which is also the same amount that it says in the textbook. And this would be the end of problem 14.3b.